Welcome to Echo Trade. I'm Jeff Roth, and today we're here with Daniel Wu from Pair Lending to talk about their portfolio growth at market pivot points. So this is a really interesting portfolio, a little bit different than some of our other portfolios within the platform, and it's absolutely destroying it this year. You've been number one on the leaderboard for a little while now, outperforming the market by a wide margin. So excited to talk about the portfolio, Daniel. Thanks for being here. Appreciate you taking some time.
Thank you. It's my pleasure to be here.
Yeah. So Daniel, quick background, is a chartered market technician, which is a very sought after certification within the industry. Spent background before starting his own companies at Charles Schwab, and then became a serial entrepreneur, all within portfolio management. Has multiple RIAs that he started. Started his own robo-advisor. So been at this for quite a long time, and we're happy to have him on the platform. But again, I'm here today to talk about the growth at market pivot points portfolio. So Daniel, I'll turn it over to you. Give us, I guess, to start, just a kind of a broad overview of the portfolio and how what goes into building the portfolio and how you look at yourself a little bit differently than some of the other kind of asset managers within the industry.
Well, the portfolio itself is different in two ways. And number one, it's a growth portfolio. I guess growth portfolio has many different definitions. The way we look at it, we're picking about the top 20, 25 biggest companies in the U.S. And they should represent the foundation of the U.S. economy. Even then, they should represent the leaders in different industries of the world economies, such as Amazon, Apple, and you name it. And those companies, they are leading in different ways in terms of technology, management, the way they push product, design products, and then they certainly have the scale and also the management skill to weather different economic situation. And therefore, their financials should reflect that too. We believe that targeting and focusing on this company would not only bring the safety of the portfolio, but also giving the long-term economic growth for the US and also for the world. And that's one aspect of it. And the second aspect is pretty interesting. We call it the pivot point, and we're focusing on the timing aspect of portfolio. And basically, it's relatively easier to find good companies, but sometimes when it comes to timing, that could be very difficult, especially the portfolio started about 18 months ago, and we started at the mid of the bear market, and therefore the timing becomes critical. Even though good companies like Apple, they have been down for 50% at one time, and due to different reasons. And therefore, when we look at portfolio, when we look at the greatest investors like Warren Buffett, and we study and what's the successful element of the portfolio, and one thing we pick it out is the time, and you can get great returns, but can you be consistent? And also how fast can you grow it? And therefore we focus on time, and this portfolio is really picking the timing, the pivot point. And then for the first 6 months of the portfolio, and the market was down, and therefore we try to time the market, be on and off in terms of risk. And if the market stays strong and we stay invested, if market stays weak, we stay in cash. And therefore, if you look at our portfolio equity curve, and there are a couple of months that is flat line, meaning that we stay our market. And then finally, you caught a market relative bottom in the last quarter of 2022, and where we start investing, and then we hold the portfolios, and they did great. And certainly, the growth portfolio have their own pitfalls, which is volatility. And such as Tesla, you can see the company is good, but also very volatile. And therefore, we need to adjust the portfolio exposures, the timing, and then sometimes we got to sell them at a certain point. So basically, in essence, it's a growth portfolio with hopefully good timings.
Yeah. So I mean, talk a little bit about the kind of the purpose of the portfolio within a broader kind of portfolio for an investor. Like you said, it's your growth focused. But did you mention it's a core portfolio? So this could be kind of like your core equity holding. Is that correct?
That's correct. Yeah. When we come to core portfolio, and typically we can put in bonds and things like that for diversification. But for the equity part, this is a core. We believe the growth companies should be in good quality, and also they should have competitive edge in all different ways. and
Mhm.
and so by all means, it is called equities.
Yeah. And so it's a core portfolio, but how would you define the risk? Because I mean, obviously, you have the more tactical side where you, like you said, you're timing certain things, at these pivot points as you describe them, and we can talk about that a little bit more. But so would you kind of determine this as a little bit more of an aggressive portfolio compared to some other equity-based portfolios?
Yes and no. I mean, by the nature of the stock, it is aggressive because they tend to be the valuation is a bit higher, and then of course they trade a bit more volatile. But we look at a portfolio and we define risk slightly different than other portfolio managers, maybe by the conventional wisdom.
Hmm.
Most of the portfolio define a risk by volatility, but we further break it down into the upside volatility, which is good, also the downside volatility, which is bad. And
Yeah.
then let's say a portfolio, if you hold it for long term, you're holding it for 365 days a year. So basically, that's 100% of the volatility. It could be upside, could be downside. And where we look at it is how much time should we be in holding the position. And if you look at the last 18 months, we don't hold it for 100%. We only hold it for the time that we think is going up. Therefore, if you measure the time we are investing in the market, in 1 year time frame, we're not 100% invested. Therefore, by that nature, our volatility or our exposure is less than 100%. So in that regard, we think the portfolio is less. And of course, it comes down to timing. If we are accurate in timing, then the portfolio should have less volatility to the downside. And we don't mind the volatility to the upside. But when the timing is bad, of course, you got in the worst of both worlds. I mean, if you buy right at the high and then sell at the low, then that's a different story.
Yeah, and so I mean, it played out last year, like you said. You opened the portfolio, you started the portfolio in the middle of the bear market of 2022, and for a period of time there, when the majority of portfolios across the industry were down, and there were no safe harbors within equities and elsewhere, you were actually up. I remember at some point last summer, like 15-17%. Well, everybody else was, calling it a win by being, only down 3 or 4 or 5% relative to the market. So that definitely played itself out last year, and then this year, obviously, you're participating in the upswing and outperforming the market again. So talk a little bit about that, because the way you go about that, in terms of determining what names and companies to put into the portfolio, but also that identifying where those pivot points are. What's the process that goes into that? Because I know, from our conversations, a lot of the industry is very fundamental in their analysis in terms of looking at, leadership within the company, PE ratios, broader macroeconomic conditions, but you're also focusing very, at these pivot points and looking at technical analysis and price charts, correct?
Correct. Yeah. So when we look at company, of course, we look at the fundamental side of it, as we mentioned earlier, but also the technical side of it or quantitative side of it is very important. So basically, our approach is to focus on data. So our
Mhm.
portfolio decision is very data driven. So we take the market data from the exchange, and then we put them into a database, and then we kind of define them in different ways, and then kind of taking a profile of a person, but instead we take a profile of each individual stocks on daily basis. And also we went further to create a proprietary stock rating system, which updates the stock on daily basis, similar to Morningstar, but they look at different parameters and they
Uh-huh.
update maybe every 3 months, and we do that on every day. So that will reflect whether or not we should be even looking at the stock at the time horizon. So of course we study volume and things like that. Whatever technical analysis or the indicators that should be relevant, we put that into machine, and then the machine has some kind of a machine learning capability to kind of screen out and what's important, so that the end result for us as a manager, we take maybe 5 minutes, a quick glance to understand what the market direction is and where the market has the momentum, and then how should we put our risks in check. Of course, we only focusing about 20, 25 to 30 stocks, so our workload is much less. And then that's the general process of our decision making. But of course, and then we focus on a result, and our portfolio analysis is pretty result driven. If the result does not reflect what it is, then we probably need to change the process and then change the parameters, whatever it takes.
Yeah. Are you looking at certain industries or themes within the broader market, or are you really just looking on an individual company basis? And you mentioned, you're really looking at, large cap companies, household names, but within, outside of just the individual companies you're looking at, are there broader themes that you guys like to place bets on, or identify, or weight more heavily, in energy versus financials, or tech versus healthcare?
Yes, we do. We cover the full market, including the 10, 11 sectors, including consumer, stable, consumer, discretionary, industrial, and everything, because they are the foundational economy, and their rotation has some kind of hints to where the market is going, whether or not. I mean, for example, right now we only have about 10 to 20 stocks that's leading the market, which is the mega cap. But whereas the other segment of the market is not moving, and then we wonder why. And then one of the conclusions we came about is that the market does not have enough liquidity to lift our boat, and therefore that's also a sign of weakness for the overall market. But in order to sort out the stability and also return, we have to focus on the sectors that are leading. And certainly right now, AI is one of the hottest theme, not only in the US, but also globally. And most people are looking at ChatGPT, and then how do they develop models. And I'm more focusing on companies that are going to emerge in the future, and how to bring the AI technology into consumer services with sustainable earning streams going forward. And just like Amazon in the internet development. So eventually we're going to see those companies, but by focusing on the AI development, we'll be able to discover and the new trends and new companies in the future. But right now, we just focus on where the market is leading us, and we just catch those trends.
Yeah, and so are you looking, when you're looking at whether it's a certain sector or theme, or an individual company, do you guys have any time horizons that you're thinking about when you open a position, or are you really just allowing the market, reacting to what's happening within the market and within price?
It's both. We have our expectation on the market. Normally, when we take on position, we take a longer term horizon, let's say a year, at least 6 months.
Yeah.
And it really depends on the market and how long the trend lasts. So if the trend doesn't last, we have to sell them due to risk management, and also to bring stability to the portfolio. But generally, we want to identify long-term trends. And for example, AI could be play out in 6 years time horizon.
Yeah.
But in between, they could come down like 20% easily within a span of 3 weeks. Then we have to adjust the position if we need to, depending on the position sizing.
Yeah, so I mean, you're looking at a long time horizon. You want to be able to hold the position for a long time and capture the majority of that upward trend, ideally, right? But correct. You have the flexibility to just, again, react to what price is telling you, and what the indicators that you guys are looking at, to be able to, okay, we're going to actually, kind of pull out of this and go to a more cash position, which is, some flexibility that some other portfolios don't have, to be able to withstand some of the longer term, kind of downturns. So, I guess if you want to just, kind of cap it off, Daniel, with for the investors, in terms of, again, how you see this as something different, for them to invest in as a core equity portfolio, but also that it has, that tactical side of it, where you're looking at the different pivot points and you have some additional flexibility.
Yeah, so people can consider using a portfolio as one of the core portfolio, and then they could add additional bonds. For example, 60% in the portfolio, and then 40% bonds to make whatever the allocation they want to. But within the portfolio, we want to be able to bring the timing aspect of it, so that within the portfolio itself, we try to bring in more stability, but also try to capture the trend, which is difficult. And you want less risk, but higher return. So this combination is not easy to achieve.
It's been playing itself out, though. It's been a fantastic portfolio within the platform since inception, from 18 months, in 2022, through difficult market conditions. So I appreciate it. Thanks, Daniel. Appreciate you taking the time.
Thank you very much.